Right, Legal in general, that's been a nice steady yield increase. And of course, this massive increase in yield here is probably not due to the dividend going up. This was the stock market crash when the pandemic hit, so the price was lower, therefore the yield looked higher. Nice to buy it there, wouldn't it? 13%. So payout ratio. The payout ratio has always roughly been in that sort of 60, 50, 60% range for most years. It dropped off a little bit in price since the start of the year, just over £3, £2.70. If we take it back to 5 years, we are below pre-pandemic levels, but not that much. Simply Wall Street estimate is that they are slightly undervalued. But the price to book ratio is 1.5, which actually, to me, for an insurance company, suggests they're actually slightly overvalued. So a lot of that compared to the equity. Although on the balance sheet itself, it doesn't look quite as bad, but it's still a big number, 60 billion. So it's not looking quite as strong as Aviva. And if you look at the growth of the dividend per share, that's been very, very nice going up there. So Legal in general is going in the B tier. So comparing it to Aviva, very sort of similar companies, I think Aviva's got slightly better valuation on it. And with the less debt situation, I think that they may have a bit more scope to increase this in the future. Right, 7% yield on this one. They've rebranded Aberdeen without any vowels in the middle. Another insurance sort of type company. Looking historically, the dividend has been, it's actually gone down a bit recently. There's no discernible increase in dividend. The price of this company has dropped dramatically over the last few years. And even since the start of last year, it's dropped a lot. So it's on a downward trend. Trading P is just 5, but the 4P is 17, which doesn't look good. Analysts are expecting 7% a year for the next 5 years earnings growth. A bit of earnings growth there. Wall Street suggests estimate as a slightly undervalued company. Price to book of 0.6. So again, that suggests it's a bit undervalued there. So I think earnings per share is going to drop off a bit. Debt has been coming down nicely. That looks okay on the balance sheet. You know what? I am going to go C tier on this one, and the C tier because if you look at the history of the dividend, there's no confidence that you're going to get a good, consistent level of increase going forward. So Phoenix Group Holdings, so on a yield basis, yeah, there's a very slight uptick, and the actual dividend itself has always been either growing or level. It's not gone down, so it's 31p a share, 41, and then it got up to 48p now, but it's quite slow growth. 4p is 9. Last 2-year price chart, well, it's on a bit of a negative trend. Analyst expectation here is negative earnings growth, negative 6% for the next 5 years. Simply Wall Street reckons it is slightly undervalued. Price to book is 1, roughly fairly valued, you could argue. Debt position, I mean, there's quite a lot of debt, 4 billion, but it's okay compared to equity. It's quite a small part of the balance sheet here. We look at the payout ratio here, and I'm not really sure about this because they've had negative net incomes for several years. So I'm not sure whether they can actually afford to issue this dividend, and I'm a bit worried about the number of shares as well. It keeps increasing. So sort of not long-term reliable for me in terms of the dividend and consistent growth. So I want to put them in the D tier. And I think, guys, this just really shows how important it is not just to look at the yield or a couple of figures, but just try and look at what the trends are, what's happened in the past, what some of the predictions are going forward. I mean, even so, this is still relatively high-level analysis. You will just spot the ones that are sort of you can strike off and then leave you with a shorter shortlist, a better shortlist, we'll call it. Okay, Imperial Brands. So this yield was around 4% for a long period of time, right about 16% when the pandemic came in, and we're looking at just over 8% now. Now, historically, there's been plenty of positive net income figures. Earnings per share always positive, and the dividend itself has been going up each year until pandemic time, and it has dropped off a bit. Payout ratio sometimes well above 100%, sometimes below. Price situation in the last 2 years, so too much to say about that. Statistically low PEs, we're looking at around about 6 for trailing and forward, and analysts are expecting very, very slight growth in earnings for the next 5 years. Again, simply Wall Street has this very undervalued, but the discount rate of 5.7% suggests you've probably got something like 10% or more if you're looking to beat the market. The earnings per share forecasts decreasing. Lots of debt, particularly compared to equity, although it has come down quite a bit. A third of it's gone in the last few years. Big chunk of the balance sheet there. Debt 10 billion, much bigger than cash. I'm less confident on this one. The debt situation, over 100% payout ratio in some years. I'm going to drop that one in the D tier, I think. You could make an argument for it to be C, but I think D tier. Right, getting into quite high yields now, and sometimes high yields can be indicative of a problem rather than an opportunity. So always do watch out for these yields when they get 8% or higher. So less history on this company. There's not too much to say. The dividend last set of results was much bigger than the earnings per share. Trading P684, P9 is a very interesting combination of figures. And let's say minus 6% a year for the next 5 years. All she says it's marginally undervalued. Forecast here sort of flattening out for the earnings. Not like in this. Look at this debt here. Much bigger than equity, 9 billion. Yeah, I mean, there's no real track record on this one. I'm going to put in the D tier because I can't really be certain about what's going to happen. There is some potential negative earnings growth. So I think D tier for them. We're almost there, guys, so stick with me and then I'll let you know what's in my portfolio. So Rio Tinto, good long-term increase in the yield. We look at the dividend number, bit of variability, but much, much higher than it has been in the past. We're at 680 for the most recent results. And recent payout ratios have always been below 100%. A bit higher in 2020, but obviously mitigating circumstances, but otherwise hovering around 40 to 50%. Bit of a good price run in the last few months as well. The numbers, single digits, 6 looking back, 8 looking forward. And the analysts are saying minus 15% a year for the next 5 years. If we look a bit more cyclical with this company, so best buy time was in the past, and we look at the share price here, it's marginally undervalued on Simply Wall Street. Their analyst pool here has got reducing earnings there as well per share. That's fine. That's pretty flat, and 12 billion, but they've got more cash and short-term investments and a lot of inventory, so not too worried about it. That's going in the C tier then with the other miners. So that's 15. So we've got 1 to go. We've got Persimmon, another house builder with double-digit yield, 11% yield here. Look at that. Bit of a mixed bag in the history. So positive net income every year with a good upwards trend, with a slight dip off in the last year or so, understandably so. Payout ratios quite high when they have paid a dividend. And that dividend has been variable in nature. Big drop off in the price, about a third of their market values come off in the last sort of 11 months. PE 9, full PE almost 9. Analysts are suggesting basically flat or to marginally negative earnings growth. Wall Street reckons they're, again, massively undervalued, but 6.2% discount rate. So on the basis of wanting to earn that sort of return, look at this, earnings not really doing anything there going forward. But I don't see any debt on this balance sheet, so that's very nice to see. And I'm going to put it in C because their record isn't as good as the companies in B tier, and their future earnings looks like it's going to be flat to marginally negative. So they got no debt. They haven't got quite the track record of the companies above. So I do hold several of these positions. So first of all, Aviva from the A tier is in my portfolio. It's one of my favourite companies, actually. And I have done a couple of videos on them if you want to check out my playlist. Aviva is returning 32% per annum. So that's a compound annual growth rate basis, which is smashing the FTSE 100 index over the same period. And for me, that's a position worth about 1,400 quid. So that is around about 3.5% of my portfolio. I wish I bought more at the time because I was very convinced this was undervalued and a bit of an obvious buy. But my sort of portfolio management hat wasn't on at that point. Bit of a learning, but yeah, very happy. See, I've got 9% a year from the dividend on them. Tobacco and Tobacco, which I put in the B tier, I also hold them. They've returned 22% a year, which is a bit better than the FTSE 100 at that time, which is great. About just getting on for 1.4% of the portfolio. And then finally, Legal & General, which I also put in the B tier, very similar holding level to British American Tobacco, maybe 1.3, 1.4% of the portfolio. And that's roughly speaking matched the index since I have got them. If you like this format of how to review your own stocks with your compound annual growth rate returns split between capital, dividend, and currency, this is share citing at a discount. If you use my referral link below, I think you get 10% off. It gives you useful information like your average cost per share, all the dividends that have come in, and you can verify those, and it will have all your transactions as well. And yeah, you've got these really useful figures. You can see the trends over time and report on it in terms of extracting between any given dates what the performances of certain things are. It's a really good portfolio management report tool, particularly if you invest for a long period of time over multiple accounts. Check out the link below for a 10% discount. That's my gift to you. And if you want to chat about these dividend stocks and you have some views on that, do consider joining my Discord server. The link is accessible via the Patreon site. If you do want to see some more dividend stocks over and above what I've just shown you, click on screen now to really potentially boost your portfolio with some more good dividend stocks.